Assalamu alaikum, dear students. Hope you are well. I am Soso. I am Muhammad Samad Khan, lecturer, Department of Accounting, Dhaka College, Dhaka. Okay, today the topic is contribution of financial leverage and capital structure. From third year, the course name is Corporate Finance and Financial Management. Okay, last class we already known that what is financial leverage and what is leverage. Okay, no financial leverage. Okay, dear students, see, financial leverage is assumed to contribute to the enhancement of return on equity, which is called ROE. Okay, financial leverage is assumed to contribute to the enhancement of return on equity and magnification of earning per share. Magnification or magnify or increasing the earning per share, and if so, it is favorable, otherwise it is unfavorable. Okay, dear students, we already seen here that financial leverage is assumed to contribute to the enhancement of return on equity ROE and magnification of earning per share, and if so it is favorable, otherwise it is unfavorable. I want to say here that financial leverage is favorable whenever the return on equity or earning per share is increased or positive, then it is favorable. If when it is negative, then it is unfavorable. Okay, dear students, we know financial leverage is debt or bond, okay, that has cost. Financial leverage is debt or bond that has cost. Okay, interest of bond or debt is the cost of financial leverage. Okay, so we know interest of bond or debt is the cost of financial leverage. Okay, we know that interest cost, we also know that interest cost is tax deductible expense. We know that interest cost is the tax deductible expense. Okay, here that actually less costly. We already learned that usually less costly, and it is likely or associated with fixed charge. Fixed charge or fixed coupon rate. Okay, fixed charge or fixed coupon rate. Okay, tax authority accept the interest cost. Tax authority accept it or accept the interest cost as the charge against profit. Charge against profit. Okay, it is tax authority charge the interest cost against the profit. Okay, so I want to say that interest cost actually cheaper or interest or cheapest, sometimes cheapest is the source, easiest source for a corporation, Okay, please see, cheaper or sometimes cheapest. Okay, it is cheaper, sometimes cheapest. Okay, so we want to say that contribution of financial leverage and capital structure, here interest cost is cheaper or sometimes cheapest. Whenever interest cost is highest, then actually it is totally unfavorable. On that time, that is no occur to contribute or the debt don't contribute to the capital structure. Okay, so here we know that interest charge is fixed charge. Interest charge is fixed charge. So interest cost maybe make a risk, make a financial risk, make a financial risk to a firm. Okay, so we say that sometimes, although interest cost is fixed charge cost, so that maybe it make a financial risk to a firm. Okay. Okay. XYZ, dear students, here I write down that XYZ Limited plan to use business capital of Taka 5 lakh with equity share capital of Taka 3 lakh Taka, okay, of Taka 100 per share, and debt capital of Taka 2 lakh of 8% interest. Okay, then tax rate is 50%, accounts payable 1 lakh, and then return on asset is 8%. We should determine whether the financial leverage is favorable or unfavorable. Okay, dear students, uh, we prove that the condition is favorable or unfavorable. Okay, okay. Dear students, we know that we already learned or known that KD, say KD equal interest into 1 minus tax rate. Okay, in the previous class we learned KD equal interest into 1 minus tax rate. Okay, please, here interest rate is 8%. Okay, so 8% into 1 minus tax rate, I mean 50%. Okay, tax rate 50%. 50% I mean 0.5. So 8% into 1 minus 0.5. Okay, 8% into 1 minus 0.5 equal 4%. So we try this in calculator. 1 minus 0.5 into 8 equal 4. Okay, so 4%. Okay, in this question we see that, or given that, total asset equal, total assets is 6 lakh. Okay, interest KD 2 lakh, sorry, it is that 2 lakh, and cost of debt equal 8%. Okay, so, and return on asset ROA equal 8%. Okay, so given that total asset 6 lakh, debt 2 lakh, and KD 8%, and ROA return on asset equal 8%. Okay, here return on asset equals, say, 8%. Okay, return on asset 8% less return on debt. Return on debt 8%. Okay, less tax shield 50%. Okay, tax shield equal 50%, I mean 4%. Some times ago I already seen the here. Okay, 4%. 8% deducted 4 equal 4%. So 8 to 4 equal 4%. Okay, benefits, it is called benefits of debt for equity holders. Okay, benefits of debt for equity holders. Okay, so in this question we see that return on asset 8%, then less return on debt 8%, minus tax shield 50% equal 4%, equal here 4%, 8% minus 4% equal 4%. So in above the question we already seen that the question, the proposal is favorable. The proposal is favorable to this firm to XYZ Limited. Okay, okay. I think that if I use, say, if I use 18% instead of 8%, okay, then what will be happen? We see that. So return on asset ROA equal 8% and then less return on debt return on debt 18% less tax shield at 50%, so 9%. Okay, deduction equal 9%. 9%. Okay, it is called 1%. I mean, I think it is benefits of debts for equity holders. Okay, here in this above the question we see that benefits of debts for equity holders negative 1%. So it is not favorable to the firm, it is unfavorable. We call that it is unfavorable to the XYZ Limited. Okay, because of high interest rate. Because of high interest rate. Okay, I think that you already learned and you already realized that what is happened in two question. Okay. Okay, dear students, I write down another question. XYZ Limited plan to use business capital of Taka 20 lakh Taka with equity share capital of Taka 10 lakh, which is 100 Taka per share. That is Taka 10 lakh Taka of 6% interest rate, and tax rate is 50%. Accounts payable 5 lakh Taka. Return on assets is 12%. So determine whether the lever is favorable or unfavorable. Okay, we should bring out the question is favorable to the firm, to XYZ Limited or not. Okay, first we should it is favorable. We should bring out it is favorable or unfavorable. Okay, return on asset equals, say, return on asset 12%. Okay, and then less return on debt is 6% less tax shield at 50%. I mean 50%, 3%. Okay, 3%. Okay, 9%. So benefits from debts or leverage for equity holders. Okay, equity holders. In this question, above the question, we see that the leverage is favorable to XYZ Limited. Okay, because 9% is positive. Okay, so at present we should bring out the EPS with totally fully equity financed or partly equity financed. Then what will be the EPS for different two system? Okay. Okay, I think it is one format and it is another format. Okay, we see that total assets is, total assets here 20 lakh and here 5 lakh. I think so. Total asset is 25 lakh. Okay, total assets is 25 lakh. Return on asset is 12%. Return on asset equal 12%. So we should bring out return on asset equal 3 lakh. It is earning for equity holders 3 lakh. Okay, here total shares, if it is fully, if it is fully equity financed, then it is here total share is 20,000 shares. Okay, 20,000 shares. Okay, then EPS. So EPS is 3 lakh divided 20,000 taka. So here 3 lakh 20,000 share. EPS is 15 taka. Another, when XYZ Limited, if XYZ Limited finance partly equity financed and partly from debt or leverage, then what will be happen, or what will be the EPS? Okay, please, we see total asset. We know total asset. So I think return on asset 12% equal 3 lakh. Return on asset 3 lakh, and debt is, I think that is here 10 lakh into 60,000 taka, that is 60,000 taka minus tax shield is 50%, 30,000 taka. Okay, so 30,000 taka. So here 2,70,000 taka. Okay, it is we say that it is earning for equity holders. Okay, so EPS is 2,70,000 taka. Sorry, here number of share 10,000 share, because it is partly financed. We already said that it is partly financed. Okay, so EPS is 2,70,000 taka divided 10,000 share. Okay, so 27 taka. Okay, please, dear students, in both category we already see that firstly we see that the question is favorable to the leverage, or leverage is favorable to the question. Then 1 and 2, First one is fully financed, equity financed. First one is fully equity financed. Then the EPS is 15 taka. Then second one is here. Second one is 27 taka. I mean here we see that partly 10 lakh taka from equity financed and another 10 lakh from leverage financed or debt financed. Okay, so if we use leverage or debt in a corporation, then and leverage, and if so leverage is favorable, then EPS must be increased. Okay, thank you all of